Good day, everyone, and welcome to today's session on transfer pricing for research and development. Today, we will be delving into the complexities of how multinational enterprises handle transfer pricing for research and development activities and ensure compliance with international tax regulations. Research and development is at the heart of innovation and economic competitiveness for many companies, especially in industries like pharmaceuticals, technology, and manufacturing. So, Module 22, transfer pricing for research and development. Now, in a global business environment, research and development efforts are often distributed across multiple jurisdictions, leading to complex intercompany transactions. To prevent profit shifting and ensure compliance, these transactions must adhere to the arm's length principle, which dictates that intercompany transactions must be priced as if they were conducted between independent parties. By the end of this session, you will have a clear understanding of the key considerations, valuation methods, compliance requirements, and real-world case studies involved in research and development related transfer pricing issues. So let's talk about research and development transactions and transfer pricing. Now, the first step in addressing transfer pricing for research and development is to understand how research and development activities are structured within a multinational enterprise, which means you have to understand the business, how the research and development is structured, or the research and development activities are structured. Now, there are two common structures exist. We have the centralized research and development, and this centralized R&D. This approach involves consolidating all research and development efforts within a single entity, often in a specialized R&D center. While this allows for greater control, uniformity, and scale economies, it introduces complexities in allocating costs and benefits to different subsidiaries or entities. Now, the second structure is decentralized R&D. Some multinational enterprises spread their research and development activities across different countries to leverage local expertise, proximity to markets, or favorable regulatory environments. While this decentralization can provide strategic advantages, it poses challenges in coordinating research and development efforts and ensuring transfer pricing reflects the appropriate cost and risk. So let's also look at types of R&D activities. Now we have basic research, experimental or theoretical work aimed at gaining new knowledge without any direct application in mind. We have the applied research, research that is conducted with a specific practical aim or objective in view. We also have the experimental development, which is the systematic work based on existing knowledge that aims to develop new materials, products, or systems. Now, these different types of research and development activities play a role in determining the appropriate pricing for intercompany transactions. So we've looked at the nature, we've also looked at the types of R&D. We've also looked at the nature, the types of R&D activity. So now let's look at the types of R&D transactions. So now, depending on how research and development efforts are structured, various intercompany transactions can arise, each requiring distinct transfer pricing approaches. Now, the approaches are contract research and development activities. We also have the cost sharing agreement and license agreement. So let us take the contract R&D services. In this scenario, one entity performs research and development activities on behalf of another and charges a fee or charges a service fee. Here, the service provider typically does not retain ownership of the resulting intellectual property. So, and assume limited risk. Now, with respect to cost sharing agreement. In a cost sharing agreement, multiple entities agree to share both the cost and benefit of research and development in proportion to their expected advantages. So each participant receives the right to exploit the resulting intellectual property in their respective region. So license agreements. For license agreement, an entity that owns the developed intellectual property licenses or an entity that owns the developed intellectual property licenses, an entity that owns the developed intellectual property licenses it to other group entities, charge royalties or licensing fees, setting the appropriate arm's length royalty rate is critical in such agreements. So let me take this again. Licensing agreement or license agreement is where an entity that owns the developed intellectual property licenses it to other group entities, charging royalties or licensing fees. Setting the appropriate arm's length royalty rate is critical in such agreements. Now, with respect to cost allocation, accurate cost allocation is crucial in determining which entity should bear the cost of research and development and in what proportion. So, under this cost allocation, we have common method that include activity-based allocation. Costs are allocated based on the actual research and development activities each entity performs. So this reflects the resources consumed by each entity and their respective contributions to the research and development process. Now, benefit-based allocation. Costs are shared in proportion to the expected benefits that each entity will derive from the research and development outcomes. This can be measured using projected sales, market share, or anticipated revenue from the resulting intellectual property. Now, all allocations must comply with the arm's length principle, ensuring that they mirror what independent entities would agree to under similar circumstances. Now, the last one, which is intangible development. A key output of research and development activities in the creation A key output of research and development activities is the creation of valuable intangible assets, such as patents, trademarks, or proprietary technologies. Now, identification and valuation. It is essential to identify and value the intangibles developed through research and development using accepted valuation techniques. With respect to ownership, establishing which entity owns the intangible and determining usage rights are equally important. The ownership arrangement reflects the allocation of risk and determines who is entitled to the returns generated by exploiting the intangible. Now, let's look at valuation and compliance for research and development transactions. Now that we have identified the research and development activities and the nature of the transaction, the next critical step is valuing these transactions. The valuation method selected depends on the nature of the research and development activities and the level of risk assumed by the entities involved. So let's look at the valuation method. We have cost plus method. Application under the cost plus method is to apply. This cost plus method is applied when an entity provides routine research and development activities or services with minimal risk. So on the application of cost plus method is when it is applied. Cost plus method is applied when an entity provides routine research and development services with minimal risk. This method adds a gross profit markup to the cost incurred by the service provider, ensuring it reflects a reasonable return on the services provided. Now, consideration identify direct and indirect costs related to research and development. Apply a markup based on benchmarking studies of comparable independent transactions. So those are the things you need to consider. Now, the second valuation method is transactional net margin method. The transactional net margin method is useful for more complex R&D services where the service provider assumes significant risk. It examines the net profit relative to an appropriate base, e.g., cost sales. The consideration here is to analyze net profit margins from comparable uncontrolled transactions. Choose an appropriate profit level indicator such as return on asset or operating margin. The third one is profit split method. The profit split method is suitable for integrated research and development activities where multiple entities contribute unique and valuable intangibles. The combined profits from the research and development activities are allocated based on the relative contributions of each entity. Now, the consideration of this is that you must identify the combined profits from the research and development outcomes, use objective criteria such as cost incurred or resources contributed to split the profits. On compliance requirements, let's look at compliance requirements. To ensure transfer pricing compliance for research and development activities, companies must meet rigorous documentation and reporting standard. Documentation. Master file. This document provides a global overview of the multinational entity operations, including its research and development strategy, organizational structure, intangibles, and overall transfer pricing policies. Now, for local file, this file focuses on material intercompany transactions, particularly research and development transactions, providing functional analysis and financial data specific to each jurisdiction. Now, cost sharing agreements. These agreements outline the terms of cost sharing, including how cost and expected benefits will be allocated. Now, let's move to functional and economic analysis. A comprehensive functions, asset, and risk analysis, which is the FAR analysis, is required to assess the economic substance of research and development transactions. This ensures that the actual functions performed, assets used, and risk assumed by each entity align with the contractual agreements or contractual arrangements. Benchmarking studies. To validate transfer pricing methods, companies must conduct benchmarking studies to identify comparable uncontrolled transactions. These studies uses industry data, commercial databases, and other sources to ensure that intercompany pricing reflects arm's length terms. Now, after the benchmarking studies, it's also important to conduct regular reviews, which is the transfer pricing health check that I've already been saying. Transfer pricing policies should be subject to regular internal review updates or internal reviews and updates to reflect any changes in research and development activities, market conditions, or regulatory environment. This process ensures that the company is always prepared for audits by tax authorities and that its transfer pricing practices remain compliant. So let's move to case studies now. Let's now look at 3 case studies that illustrate how transfer pricing for research and development activities is applied in practice. So looking at case study 1, let's look at a case where there is a centralized research and development services. So ABC Pharmaceutical Limited, a multinational pharmaceutical company, centralizes its research and development activities in Switzerland, providing services to its subsidiaries worldwide. Now, with respect to valuation method, now let's look at the implementation. Now, how did they value this? ABC Pharmaceutical applies a 10% markup to the research and development costs using the cost plus method based on benchmarking studies of similar independent services. Of course, the outcome, this method, ensures compliance with both Swiss and international regulation while allowing ABC Pharmaceutical Company to maintain control over its research and development operation. And centralization also leads to streamlined processes, better coordination, and cost savings. So you can see that with the detailed documentation and robust valuation method, which ensure compliance with transfer pricing regulation in Switzerland and other jurisdictions, and it also help with efficiency. Now, case study two, where we have a cost sharing agreement for research and development. Now, DEF Technology Limited, a global technology company, implements a cost sharing agreement between its US and German subsidiaries to jointly develop new software technologies. Now, the valuation method, the company applies the profit split method, dividing profits based on each subsidiary contribution. Now, this approach ensures an equitable allocation of profits while complying with transfer pricing regulation in both the US and the Germany. So that's the outcome. There's an equitable allocation. The profit split method ensures an equitable allocation of profits based on the contribution of each entity, and the comprehensive cost sharing agreement and detailed documentation also ensure compliance with transfer pricing regulation in the US, Germany, and other relevant jurisdictions. So now let's look at the third one. The third case study, licensing of research and development intangibles. So we're looking at GHI Electronics, a multinational electronics company, develops innovative technology in Japan and licenses the resulting patent to a subsidiary. Now, the valuation method they have adopted here, GHI Electronics uses the relief from royalty method to value the licenses. Now, estimating the present value of future royalty payments that would otherwise be made by the subsidiary. Well, the outcome is accurate valuation and audit preparedness. So the detailed documentation and accurate valuation of the intellectual property ensure compliance and prepare the company for potential audits. Now, to conclude, transfer pricing for research and development activities requires a meticulous approach to ensure compliance with international tax regulations. The key takeaways from today's session include understanding the structure, whether research and development is centralized or decentralized, significantly impacts transfer pricing consideration. Now, choosing the right valuation method is also important. The appropriate method depends on the complexity of the research and development activities and the level of risk assumed by each entity. Now, comprehensive documentation, accurate and detailed documentation is essential for defending transfer pricing position in audits. Regular compliance and review, ongoing reviews here adapt to regulatory changes and ensure the multinational enterprises practices remain compliant. So by applying all these principles, multinational enterprises can ensure their intercompany research and development transactions reflect arm's length principle, mitigate tax risk, and foster sustainable growth through innovation. Thank you for your attention.